Something doesn't make sense. Right now, global demand for silver is hitting levels we've never seen before. Industrial consumption is surging. Supply is struggling to keep up. And in some segments of the market, inventories are quietly being drained faster than they're replaced. By every traditional measure, this is the kind of setup that should push prices aggressively higher. And yet, when you look at the chart, silver doesn't reflect that urgency. It moves, but not in a way that matches the pressure building underneath. So you're left with a contradiction. On one side, the fundamentals are screaming shortage. On the other, the price is behaving like everything is under control. That gap doesn't usually last, because markets can ignore reality for a while, but they don't ignore it forever. And what makes this moment different is how quietly it's happening. There's no panic, no mainstream alarm, no widespread attention, just a slow, steady build of pressure beneath the surface. Which raises a question that most people aren't asking yet. If silver isn't moving the way it should, then what's holding it back? And more importantly, what happens when it finally doesn't? Before we go further, it's important to understand what this is and what it isn't. This isn't a hype cycle. It's not a silver to the moon narrative built on excitement or short-term speculation, because those stories come and go, and they usually miss what actually matters. We don't follow price. We follow structure. We look at how systems behave under pressure, where imbalances begin to form, and more importantly, where those imbalances are being ignored. Because the biggest moves in any market don't start with headlines. They start quietly, in places most people aren't paying attention to. So this isn't about chasing a breakout. It's about understanding why a breakout might become unavoidable, not based on emotion, but based on underlying reality. Because when you shift your focus from price to structure, you start to see something different forming beneath the surface. Over the past year, something has quietly shifted in the silver market, not in a way that grabs headlines, not in a way that immediately shows up in price, but in the underlying structure, the part of the market most people never see. Start with demand. Silver is no longer just a precious metal sitting in vaults or used for coins. It has become a critical industrial component. Solar panels, electric vehicles, advanced electronics, even emerging AI infrastructure, all of it relies on silver's unique conductive properties. And as these sectors expand, so does their need for it. But here's where it gets interesting. That demand isn't slowing down, it's accelerating. Now look at supply. Mining output hasn't kept pace. New discoveries are limited. Extraction costs are rising. And production growth remains constrained, which means more silver is being consumed than replaced. That's what creates a deficit. Not a temporary imbalance, but a sustained gap between what the world needs and what it can produce. Then there's the part most people miss. Inventories. Across major exchanges and storage systems, physical silver holdings have been steadily declining. Not dramatically in a single moment, but consistently over time. A slow drain that doesn't trigger alarm until you realize how much has already been removed. So when you step back and connect it all, the picture becomes clearer. Rising demand, limited supply, shrinking inventories. Individually, each of these can be explained, but together, they point to something deeper. Because this didn't happen overnight. It's been building. And this is where the story starts to break. Because if everything we just laid out is true, rising demand, tightening supply, declining inventories, then the price of silver should already be reacting. But it isn't. At least, not in the way you'd expect. Instead, what you see is a market that feels controlled, moving, but not reflecting the urgency underneath. Almost as if the visible price is disconnected from the actual pressure building behind it. And that's where the contradictions begin to stack. On one side, physical silver is becoming harder to source in certain channels. Premiums fluctuate, delivery times stretch, and inventories quietly decline. On the other, paper trading volumes remain massive. Contracts are bought and sold in quantities that far exceed the amount of physical silver that actually exists to back them, which means most of the price discovery isn't happening in the physical world. It's happening in a financial layer, built on top of it. Then there's the silence. Mainstream coverage remains minimal. No widespread concern. No urgency in the narrative. But beneath that silence, something else is happening. Institutions are paying attention. Not loudly, not publicly, but consistently, which creates a divide that's hard to ignore. The public remains distracted. while those closest to the system appear to be positioning. While those closest to the system appear to be positioning. And when those two realities drift this far apart, it usually signals something deeper, because it leads to a question that shouldn't exist in a functioning market. How can a real, physical shortage begin to form without the price reacting to it? To understand why this disconnect exists, you have to look beneath the surface of the silver market itself. Because what most people see as the price of silver isn't purely driven by physical supply and demand. It's heavily influenced by a parallel system, the paper market. This is where silver is traded through contracts, derivatives, and financial instruments, often in volumes that far exceed the actual physical metal available. It's efficient, liquid, and widely used for price discovery. But it also creates a layer of abstraction, because when price is determined in a system where most trades never result in physical delivery, the connection to real-world scarcity becomes less direct. That doesn't mean the system is broken. It means it operates differently than most people assume. In this structure, large volumes can be moved quickly, positions can be adjusted, volatility can be managed, and in many cases, stability becomes a priority, especially for institutions that rely on predictable markets, which introduces an important dynamic. If price discovery is happening primarily in a financial layer, then physical pressure doesn't always translate immediately into price movement, at least not right away. And that leads to a more nuanced possibility. What if the price of silver isn't failing to reflect reality, but is being shaped by a system designed to absorb that pressure over time? Not to suppress it indefinitely, but to control how and when it surfaces. Because if that's true, then the real question isn't whether silver is undervalued. It's whether the market is functioning exactly as designed, until it can't anymore. When you strip away the narrative and look directly at the data, the structure becomes much clearer and much harder to ignore. Start with supply. Silver mining isn't scaling the way demand is. Most silver isn't mined as a primary metal. It's a byproduct of mining for other resources like copper, lead, and zinc, which means even if demand for silver rises, production doesn't automatically follow. Add to that declining ore grades and rising extraction costs, and you have a supply side that is not only constrained, but increasingly inflexible. Now compare that to demand. Silver is no longer just a store of value or industrial input, it's becoming a critical component in modern infrastructure. Solar panels require it for conductivity. Electric vehicles depend on it for circuitry. Advanced electronics and emerging technologies continue to expand its use. And unlike some materials, silver is often consumed in ways that make it difficult or uneconomical to recycle. So demand doesn't just grow, it compounds. That's where the imbalance begins. Because when you look at recent years, the silver market has consistently operated in deficit, meaning more silver is being used than is being produced. Not once, not occasionally, but repeatedly. Now bring in above-ground supply. The total available physical silver stored in vaults, held in reserves, or accessible through exchanges is not unlimited. And as deficits continue, that supply slowly gets drawn down to fill the gap. Compare this to past cycles, and the difference stands out. Previous imbalances were often shorter, more cyclical. What we're seeing now is broader, more structural, which leads to a realization that changes the tone of the entire market. This isn't a temporary spike in demand. It's sustained pressure, building over time. When you zoom out, the silver story stops being just about supply and demand and starts looking like part of a much larger shift. Because this isn't happening in isolation. Across the global system, there's a quiet but consistent move toward securing real, physical resources. Countries are no longer relying purely on financial assets or currency reserves. They're thinking in terms of control over energy, over materials, and increasingly, over strategic commodities. Silver sits right in the middle of that shift. Now look at where this activity is most visible. In emerging markets, and especially in China, there's a clear pattern of long-term positioning, investments in mining, control over supply chains, and a focus on securing inputs for future industrial growth. Not for immediate gain, but for strategic advantage. At the same time, the global monetary landscape is evolving. Discussions around reducing dependence on the dollar are becoming more frequent. Trade agreements are shifting. Alternative settlement systems are being explored. None of it is happening overnight, but the direction is becoming harder to ignore. Now compare that to the West. Financial markets remain highly liquid, highly leveraged, and heavily focused on paper assets. Capital flows through instruments, derivatives, and digital representations of value, efficient, but increasingly abstracted from the physical world. So you end up with a contrast. In the East, there's accumulation of tangible assets. In the West, there's expansion of financial structures built around them. And silver bridges both worlds. It's not just an industrial metal, and it's not purely a monetary asset. It's both, which makes it uniquely positioned in a system that may be transitioning between two models. And that leads to a deeper question. Is what we're seeing really about price movement? Or is it about positioning ahead of a much larger shift in how the system itself operates? At this point, the direction of silver becomes less uncertain. But the path it takes, that's where everything changes. So what does all of this actually mean? When you step out of the theory and into real decisions. For long-term investors, the picture becomes clearer. Silver starts to look less like a trade and more like a positioning asset, not because of short-term price targets, but because of what it represents inside a system that may be shifting. An asset tied to real-world demand, limited supply, and growing strategic importance. That changes the objective. It's no longer about catching the perfect entry or exit. It's about recognizing that the accumulation phase may still be open and using that window before the broader market fully adjusts. For short-term traders, the focus shifts in a different direction. Volatility. As pressure builds, price behavior becomes less predictable and more reactive. Moves can accelerate quickly once key thresholds are reached, which means the signals matter. Inventory levels, physical premiums, delivery timelines. These become early indicators of stress in the system. Timing becomes sharper. But across both approaches, one idea stays consistent. This isn't about perfectly timing the top. It's about recognizing that a shift may already be underway and positioning before it becomes obvious to everyone else. At a certain point, all the data, all the charts, all the analysis, it starts to point back to something very simple. Demand for silver is real, not theoretical, not speculative. It's being used, consumed, and integrated into the systems that power the modern world. And yet, the price hasn't fully caught up to that reality. Not yet. But markets have a way of resolving these gaps. Not immediately, not always in a straight line, but eventually. Because markets don't ignore reality forever. They absorb it, delay it, sometimes even mask it, until they can't anymore. And when that moment comes, it rarely feels gradual. It feels sudden, like something that was always there, but only becomes visible all at once. That's what makes moments like this difficult to interpret in real time. Everything still looks stable on the surface, but underneath, the pressure continues to build. So the question isn't whether silver will eventually reflect the truth of its demand and scarcity. It's when, and more importantly, who will recognize that shift before it becomes obvious. Because by the time price fully aligns with reality, the opportunity isn't discovered. It's already gone. And that leaves one final thought. When silver finally tells the full story, will it already be too late to listen?